What's up, everybody? Welcome to your weekend review for the week of Monday, September 12th, 2022. And oh, what a week it was. Monday started off fast. We had optimism of having a good day, but it all got squashed as the day went along. Early in the morning, the MBS were up 20 basis points and the S&P was up 40, both winning. However, as the day went on, the bonds lost their traction and slid to a loss of 16 basis points in total. A gauge of the dollar fell for the second day on track to the biggest two-day drop in almost 3 years as all G10 peers surged except the yen. Investor focus is on August U.S. inflation data, which is coming on Tuesday. Headline CPI is expected to cool to about 8% on the year. The core measure, which excludes food and energy, is seen accelerating. Traders almost fully expect another jumbo-sized Fed rate hike of 75 basis points next time around. However, they want some insight as to what's going to happen after that. This week's economic calendar will feature a parade of inflation-related releases, CPI on Tuesday, PPI on Wednesday, and inflation expectations on Friday, as well as some Class A settlements. MBS were testing the ceiling at 99.16 early in the day, which failed, and now we're in that very tight range with a ceiling of 99.16 and a floor of 98.641. A lot of this also had to do with a bad auction today. It was rated a D with a bid to cover of 2.37, which was below the average of 2.48. There's been a lot of corporate issuance lately. I think the bond market is kind of loaded with debt offerings. So everybody's weighing their yields versus each other. Like I said, we are in that range. We've been range trading for several days right around where the 99.16 and 98.641. We also got news that from Housing Wire that Rocket and UWM and Finance America and PennyMac have all raised their conforming limit to 715 coming into the new year and accepting locks on that amount. And we had a pretty terrible day all around on Tuesday. Rough market open with MBS being down 48 basis points early, S&P down 105 points. Had some bad headwinds coming into the day after the completion of Monday's $41 billion three-year note auction that was met with weak demand. And the bond market backtracked into the early afternoon after $32 billion worth of 10-year notes reopened and met with underwhelming demand as well. This sent Treasury yields to fresh highs on the year. Took it place into the overnight and everything like that. And then on the open, we got bad numbers from the Consumer Price Index. It rose 0.1% in August when it was expected to go back down. Still, the 0.2 difference doesn't seem like a lot except for the fact it's moving in the wrong direction after unprecedented amounts of Fed funds raised. The monthly core CPI, which is mainly what the Fed looks at, was at 0.6 versus 0.3 forecast, which is a pretty big miss. The market really is not liking this plus 0.6 on the core CPI. It's double the expected 0.3 increase and indicates that the Fed fund increases are not really working. I've personally given up hope of not recession happening. We're going to have a hard landing, but also with CPI being up 8+%, shelter being up 0.7% on the month, rents up 0.7%, and 6.7% year over year, which actually seems low. Food is up 0.8 month over month. Credit card debt is growing at $3.5 billion year over year. Exactly what are we expecting to happen that's so bad from this recession that isn't already happening? Oh, wait, politics. I guess the theory is it doesn't suck until the government officially says so coming into an election year, which is pretty tired. Also, if supply chains weren't bad enough already, there is a possible railway strike coming, so that should be fun. Hopefully they can miss out on that. The Fed Fund futures are already predicting a 75 basis point increase at the next Fed meeting and an 18% that we get a full 100 basis point hike. The November futures are now pricing in 75 basis points as well. And the December's futures now see a better than 70% chance of a 4 handle on the Fed funds rate at the end of the year. Needless to say, this report is highly bearish and raises the chances of a hard landing in the economy. Like I said, it's just happening. Given that we have started the year with a negative GDP growth and we haven't begun to feel the effects of the summer rate hikes, I think the recession is inevitable. Like I said, the MBS ended up being down 52 basis points on the day. It hit that resistance at 99.718 and then came back into the range, a very tight range there of 100.531 to 99.781. Going to have to see how this is all processed tomorrow. We also got a post from our sponsor at WellThatMakesSense.com. Another one from our series on how to win friends and influence people. Stop using the word but when you start with praise before criticism. Once you hear that, they may question the sincerity of the original praise. So just flip it around. Or in most cases, you can actually just change the word but to and it sounds a whole lot better. September 14th, MBS were down 11 on the open, but ended up being up 9 basis points on the day. Now that idea of a full point rate hike is catching on. We will see some bigger hikes in November and December. It's not likely to see rates drop too far, but we have some room to improve. Inflation at a wholesale level fell 0.1 month over month and a rise of 8.7 year over year. The decline was primarily a big decrease in energy prices. So excluding food and energy, the monthly index actually rose 0.2, which is 8.1 year over year. The report was more or less in line with street expectations, so we didn't see any massive changes as a result of that. Will this have an effect on the Fed funds plan for next week? Probably not. Fed futures now hold a 70% chance of 75 basis points next week when that comes out. The 2-year bond yield has picked up 23 basis points in yield over the last 2 days, while the 10-year is up about 8 basis points, so it continues to invert more and more, indicating the market sentiment that we are going into a recession. MBS broke below the floor of 99.718 and regained back above it, so the floor has held the last 2 days. Hopefully we can make a run back up and get back above 100.531, which would be good. Yesterday, MBA and several industry trade organizations submitted a letter to the White House and the National Economic Council urging them to reduce the FHA's monthly mortgage insurance premium to help with home affordability. They could also raise those limits a little bit. That would be nice, wouldn't it? PIMCO is some news today. So a lot of people were declaring non-QM loans dead after PIMCO backed first guarantee collapsed a month and a half ago. However, news is PIMCO is back bidding on non-QM loans. So I guess they decided that the crappy company they own just wasn't worth keeping around. So everybody needs to accept that that wasn't a statement on non-QM. It was a statement on that not being that good of a company. We also got another post from How to Win Friends and Influence People out of our sponsor at Well That Makes Sense. How to win people to your way of thinking. Facts and figures aren't enough. Your pitch has to be entertaining and include visualization. So check out that full post at WellThatMakesSense.com. And then the bloodbath continued on Thursday. MBS were down 20 basis points really early. Bonds were steadily weaker in the overnight session, and it was pretty much just a tick-by-tick linear sell-off all night. Initial jobless claims were forecast for 225,000 and came in at 213,000. Job market staying strong. Continuing claims came in on target at 1.4 million. Retail sales actually rose 0.3 month over month in August, which was above expectations. Excluding vehicles, they fell 0.3. Excluding vehicles and gas, they increased 0.3. Miscellaneous retail stores rose 1.6. People are still spending money. So that's going to give the Fed extra ammo to be able to raise rates even more without worrying about a recession that's probably already here. But it looks like people are just going to go ahead and keep spending money right into the recession. Industrial production fell 0.2 in August, which is not going to help our recent bad efficiency and productivity ratings. At the end of the day, we ended up being down 34 basis points on the day. It was a little bumpy along the way. All in all, it broke through that floor at 99.781, which was kind of holding up, and even went down to test the new floor at 99.375. It also appears the government has averted a rail strike. That would have made things much worse in terms of the supply chain of getting goods around the country, because so much stuff gets transported by rail, and it is a very efficient way to transport goods. There are also some concerns in the mortgage banking world around the finalized Ginnie Mae risk-based capital rule. Essentially, what this is going to do is going to raise the capital requirements for companies that service Ginnie Mae, which is FHA, VA, and USDA loans. Apparently, Ocwen Financial, which is a giant servicer, will not meet the new rules. The pool of eligible Ginnie Mae MSR buyers will now shrink quite a bit because people won't want to buy them and service them. This dynamic will increase the upward pressure on FHA mortgage rates and be a positive thing for people like Mr. Cooper and Guild Holdings, especially since Wells Fargo is scaling back on buying and holding outside TPO-generated mortgages. We also got a post from our sponsor at www.wellthatmakessense.com from How to Win Friends and Influence People. I believe it's the last one in this series. It ain't much, baby, but it's all I got. So it's all about giving the best you can and letting the other guys save face. So this is all about getting along with people, doing the best you can. Make sure you are learning about how to win friends and influence people at www.wellthatmakessense.com. And Friday was another fairly eventful day. Although the net wasn't a big change, it was pretty bouncy along the way. Pricing in the morning was a bit worse than yesterday as mortgage bonds continued the death by 1,000 paper cuts. Reprice risk on the day was low because there really wasn't much news. Fed Reserve officials will signal a more hawkish stance next week. Everybody is basically anticipating a 0.75 of a point raise by the Federal Open Market Committee on Wednesday. This will be the third consecutive policy meeting where they raise rates by 0.75 of a point. Though it's happening a lot lately, it is historically significant that this is happening 3 times in a row. This will raise the policy benchmark to 3 to 3.25%. All the good money is on it being over 4 when we hit the new year. The rise in interest rates this year have caused MBS spreads to widen considerably. When the MBS spreads are large, aka wider in trader parlance, it means that mortgage rates are high relative to the underlying interest rates. So this is saying that people want a higher premium for mortgage-backed securities because they feel like they're going to pay off next year. So they're just going to get their money back and have to reinvest it at lower interest rates versus a treasury, which won't pay off and will pay the current rate of interest for the entire term of the note. However, the money is banking that MBSs are going to pay off next year when rates come down in a recession. So therefore, they want extra premium for this short period of time. Like we said, MBS were down 8 ticks early, ended the day being down 3 ticks. Again, we went down and tested that floor at 99.375, which held up. Happy about that. We don't want to see it keep going lower. Next week, we're probably going to have to evaluate moving to a new coupon rate. A preliminary University of Michigan Consumer Sentiment Survey for September rose to 59.5 from 58.2. So people are feeling better about the economy for some reason. Probably just gas prices are lower and they can go around and do stuff. Looking at next week, it's going to be a very busy week with news. We have housing market index on Monday. Tuesday, we get some housing starts as well as a 20-year bond auction. Building permits come in that day as well. All eyes will be on the Federal Open Market Committee on Wednesday when they give their rate decision and the verbiage to go with it. It's going to be a big day. All eyes will be on that. Bank of England is going to do their version of it on Thursday, as well as a 10-year note auction. So that'll be the first taste of how the market is digesting the Fed news. And then on Friday, we get PMI, which is producer inflation news. So it's going to be a bouncy week next week. Get some rest over the weekend. And if you can, definitely check out our sponsors and check out our influences. So these are the people we look at all week to generate this commentary. Check them out and make sure to go to www.wellthatmakessense.com. Have a great weekend.